All right, guys. It's been a while since I made a video, and I didn't really. I tried to make a couple, but it just didn't pan out, and my bias was still long, so I didn't feel like changing anything about what I was saying. You know, I didn't want to just like spam the same, parroting myself over and over again to try to get like views or something. Not really about that. I wanted to actually make a video when I had something worth saying that was new, and I do now. Unfortunately, the probability of a rate cut is being priced in for the next Fed funds rate decision. And if you've seen my previous videos, you'll see that this is a very interesting chart to look at. It's pretty simple. Okay, it's from the Federal Reserve's website, and if you look, these on this chart, the shaded areas here, 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 and here, all indicate U.S. recessions. Okay, now, which direction ultimately is the federal funds interest rate heading during each of those recessions? Do you notice a common pattern here? I do, because during this recession, rates decreased. During this one, rates went down. They went down. Here they went up, but ultimately went down by the time the recession, it was still happening. They go down. Okay? During this one, they were going up, but then they sharply went down during that recession, right? And then this one, they went up right before it, and then during it, rates sharply declined. Now, in the late 70s, interest rates were really high. But anyway, as they started to decline them, there was a recession. Then another recession here, right? In modern times, or more modern times, dot-com crash. Look, rates were going down. The Great Recession, rates were going down. Even during the COVID crash, rates had already started going down in 2019, and then they quickly dropped them really fast when COVID hit. So now if you go and look at the chart for all of these, it's not always like perfectly clear, meaning the market can still go up a bit while they cut rates, or it can go down right away. Like in this case, the market just went down while they were cutting rates, right? In this one too. But sometimes the market will go up a little bit more while they cut rates, like in this one. The market hit all-time highs right before COVID, and then plummeted while they finished cutting rates. I think really what's going on is it's kind of a large-scale, longer-term version of a liquidity sweep. So if you look, let's go on a weekly chart so you can see. Before the COVID crash, basically, they started cutting rates around here. The market grinded higher, and then COVID happened, right? So it seems like COVID's the reason for the crash, which it was, or the reason why it was so fast and abrupt. But realistically, it was conveniently timed with interest rate cuts, right? So the market pushed higher, baited in bulls, longs, crashed, right? As soon as rates hit zero, the market quickly began correcting because it began pricing in eventual higher interest rates, right? Now the rates were still at zero when this crash began to happen, but this was due to a 2,339-day Michael S. Jenkins cycle, right? But as they began raising rates starting in March, as you can see, they raised rates, and then the market it struggled to like really go way lower. It did go lower, but this was it was kind of a mild crash. Not like mild, but like it wasn't like a dot-com or financial crisis type of crash, right? And the reason that the crash stopped happening in 2022 was because they raised interest rates, right? Then they began cutting rates at the beginning of, or sorry, last year, right before this crash. This began anticipating rate cuts, so it went lower. Rate cuts happened, started to grind higher, right? They cut rates again in December, and then, lo and behold, began crashing due to quote-unquote tariffs, right? Which may have had an impact, but similar to the COVID crash, it's conveniently timed with an interest rate cut. Okay, now we are seeing a high probability of rate cuts happening in September. Well, it looks like it's already starting to price that in, right? It's starting to dip lower as soon as they started saying rates are going to get cut next time. The market has started to push lower. So that's just something to be of note. Now, furthermore, if you look on Reddit, this is just one post, so this could be a selective bias thing, but I'm noticing this kind of sentiment starting to increase. Look at this guy's post, and yes, I was banned from here, and the reason I got banned from Bogleheads was literally because it wasn't even in a post, but in a comment I tried to explain my beliefs about the market, and they banned me for it. Isn't that crazy? So I tried to speak the truth about how crashes were predictable and timeable, and how inflation pumps up stock prices, because there was some posts saying like basically we don't know why the stock market keeps going up in the long run. And I was like, that's ridiculous. It's because of inflation. And then they banned me. So they don't really want the truth out there. They just kind of, because who owns Reddit? Advanced Publications. Now, I'm not saying it was a massive conspiracy against me particularly. I'm just saying that the general vibe on Reddit is they want to promote the lies, and they want to suppress what's true. I mean, that's my only explanation, because I don't know why my comment got deleted and I got banned for something so small. Anyway, so yeah, just like I like to inverse Reddit too, especially when Reddit goes along with the news, which I'll get to in a second. But basically, some random person, supposedly some random person, but it might not be a random person. It might be a planted post, because Reddit can control their algorithms, and they can control which posts kind of rise to the top of the feed of a subreddit, right? So anyway, this person's saying they're finally going into the market. Now, today, they finally bought into the market with 100K cash. Oh, no, wait. With 20K cash, but they're going in. So anyway, what this is saying is they're saying they're finally going in, and, to me, that's just like another small piece, but that's another signal for the top, is people are going to start to follow this type stuff, right? Okay, now, you go to Business Insider, and I'm starting to see this kind of sentiment formulate more across different news media websites. It hasn't, gotten super strong yet, but I'm starting to see signs of that. Okay, especially today on Business Insider. Why years-long bear market slumps may be a thing of the past. Now, that's a concerning post for me, because if you're trying to inverse the news, what is that saying? That's saying that if they cut rates and they cause a crash, this crash could last for years, right? I'm not saying, this one article is guaranteeing that, but it's just like, you got to think if they're trying to make people assume that a crash could never last longer than a year, well, then, what's on the table now is a multi-year bear market, like a dot-com crash or a financial crisis type thing, or a Great Depression type thing. Look at this next article. What tariffs? S&P companies are wrapping up one of the strongest earnings seasons on record. Okay, another bullish article. Look at this article too. Morgan Stanley sees the AI productivity boom adding $16 trillion to the stock market's value. Okay, so all of a sudden, Business Insider, which was previously, and then look at this one too. Why one analyst thinks Nvidia could double its market cap to $9 trillion by the end of the decade. This is probably true, but again, you have to think about the timing of when this article is coming out. It would be very convenient for this article to come out before a major crash. By the end of the decade, Nvidia could hit that, but look at this. You got 4 bullish articles. Just so anyone reading Insider today who's uninformed is all of a sudden, they are now bullish on the market, right? And Nvidia, Business Insider was posting a lot of bearish articles recently. Okay. I guess this is a bit of a bearish article, but that's more about crypto, anyway. Look, like this, see? A week ago, they were saying that the stock market could, lose, like basically the crash could start happening, right? Okay, so a week ago they say that, and now that it's starting, all of a sudden they're bullish, which it's like, okay, So anyway, the point is, what should you do? Well, I cannot give financial advice legally. I'm not a certified financial advisor, but there's a couple things I see potentially happening. Okay, what is the bull case? If they don't cut rates, and then I will see the market most likely grinding higher, save for any sort of black swan event, right? If they do cut rates, which it seems actually is the more likely outcome, I see the market crashing. Okay. Now, in terms of the day of the rate cut, now this is a little more, fancy type trading, and I can't guarantee this is exactly what's going to happen. But if they cut rates, the day of the rate cut, what I see happening is you'll see the market most likely shoot up for like half an hour or so following the rate decision, or for the rest of that day or whatever. And then a bunch of people are going to be like, oh, the rate cut saved the market, right? And then you're going to see a massive flush, right? So they're going to bait in longs, trick in a bunch of long liquidity, and then the people who actually know what's going on are going to use those buyers as counterparty to their massive short sells. And then the market's just going to start going down. Now, another option for it is that if somehow right now, if the market ends up going up higher from now till the rate cut, like I said, that could happen. Or what you could see happen is that the market keeps going higher after the first rate cut or whatever. But after consecutive rate cuts, the second, maybe third rate cut, out of nowhere, again, you're going to start to see a massive flush, right? So I can't guarantee exactly when the timing will be. For all we know, this right here is the crack. This right here is the crack. That's the beginning of a, what this was starting out to be, right? And if rate cuts happen and cause a recession, my opinion is that you will see, depending on the severity of it and depending on how long they keep cutting rates, very probable that this low from the tariffs gets taken out. And also possible that the low from 2022 gets taken out. Now that sounds really unlikely because that's like a 50% drop. And maybe the S&P wouldn't see a full 50% drop, but I definitely think that NASDAQ could see a 50% drop for sure. Because, let me go on a weekly. Okay, look at the .com bust, right? This thing just went insane, right, during the internet, when the internet was created. It lost almost all of its valuation, right? Did that mean that there were that was all just crap companies? Like, were these companies that didn't have innovative products? No, but Wall Street is about more than just having a good company. Like, a good company has to survive recessions and stuff, right? Like the market is a place where Wall Street rips people's faces off. It can be a good company, but if with the rates going down, they're going to readjust banks are going to readjust their lending profiles. A lot of people are going to refinance their debt to zero, to lower rates than what they're getting. And so basically a bunch of debt's going to get destroyed. It'll be reacquired, but at lower rates. So the fractional reserve lending process gets slowed way down, which basically is disinflationary, and that drives prices down. At least that's what, as far as I understand it, that's what happens. So if they're cutting rates, then again, look again. So during rate cuts, disinflation happens. Rate cuts again, disinflationary, right? And when you see disinflation, look at what does it do to prices? Think about it. If the purchasing power, I'm holding a dollar bill right now. If the purchasing power of your money goes up or stops going down due to lending grinding to a halt, that means that prices are going to go down or they're going to stay the same, right? So like a little bit deflationary, mostly disinflationary, because inflation is so prevalent that it's like you don't really see deflation in the American economy, except for a little bit. I think during this one there was like a mild amount of deflation actually. That's how severe it got. But basically if lending grinds to a halt, all of a sudden the purchasing power of your cash is at the strongest it's ever going to be for the rest of your life, right? And so when your cash is as strong as it's ever going to be, then prices don't need to go up, right? They can actually even go down. And then as soon as they start raising rates or that rates can't go any lower, banks begin to anticipate higher rates again, and so then they begin lending at variable rates instead of lending at a fixed rate that's higher than the federal funds rate. They're going to lend at variable rates because they know rates will eventually go up, right? So and so that's why for the past year or two, when rates hit their peak, now it was a matter of time, but we didn't know when they were going to start cutting rates. But that's why you see a lot of that's why you see a lot of, for the past 2 years, you've seen a lot of fixed rate advertisements for like mortgages, car loans, just anything like that. You see a lot of but especially mortgages. Like I've seen so many ads thrown in my face by different, banking institutions about like, get in this fixed rate mortgage, right? And it's like, well, why are they advertising fixed rates? Well, if a bank is advertising fixed rates, that means they don't see rates going higher in the near future. They see rates going lower, right? Because a bank's job is to capture the spread of like whatever transaction they're doing, right? If the bank lends to you at a 4.5% or a 5.5% interest rate, it's because they see that the federal funds rate is 4.5% or whatever, right? And so they're trying to capture that 1% spread, essentially. I mean, they're creating the money out of thin air anyway when they make you that mortgage, and so they're collecting interest off money that they just made out of thin air. Like it's not, it's only a risk to them if you default on it, because then they have to pay that off. They have to destroy the debt themselves. But still, anything that's above the federal funds rate is good for a bank to lend at, right? So that's, in a sense, their kind of spread. So when you see fixed rate mortgages being promoted for the past couple of years, rates aren't going to go higher, right? It's just a matter of when do they start reducing rates. And when they start reducing them, which they did last year a bit, right? And so that's what I believe. I know there were tariffs, but there's still tariffs, and the market went up during the tariffs, starting to come into effect in anticipation of that. And I know that starting in August, right, a lot of tariffs go into effect, and so you could argue that that's what's going to cause the crash. But again, very conveniently timed with rate cuts, because tariffs alone I don't think would crash the market. It's the fact that rates are going down. That's what's really the catalyst of it. So, rates started to go down around here, and look what happened after, right? Just saying, I understand there were tariffs as well, but you'll notice this in history. There's always some other sort of scapegoat that shows up with the rate cuts, and that makes the public think it's about the other thing, but they're not paying attention to the rate cuts. And then furthermore, the news always, and public, the masses, always seem to think that rate cuts are bullish, and yet they fail to look at history. So anyway, I'm probably going to try to wrap this up. Went on a little longer than I intended for it to, but the point is, just look to inverse the news and the public opinion, and pay attention to what the federal funds rate is next. Apparently, there's at least like above a 70% chance that they're going to cut rates. So, that to me is like, those are pretty high odds. So, yeah, just be prepared to see the market go a lot lower. And you're going to see a lot of people, especially if you see this euphoria that's kind of coming out of nowhere, and all of a sudden everyone's bullish, and you're like, where did these people come from? Like, where were these people here, right? Where were these people over the past, like, where were these people sent from the beginning of 2023 till now? And now all of a sudden a bunch of people are going to come out of the woodwork and get, like, think it's guaranteed bullish. If you were there for the GameStop thing, just think about it like that. That's like a microcosm of what happens with the overall market on a longer term scale, right? When I was newer to trading, I lost money on the GameStop thing because I had no clue what I was doing at the time, right? And so when the GameStop thing happened, I saw it coming too because, well, in a sense, not really. If I'd seen it coming, I would have made money off it. But sometime around here, I saw an article that said that Michael Burry said that GameStop was undervalued. Totally blew it off. Okay. Then in late 2020, I saw GameStop hit like $4, and I was like, dang, this thing's up, like, it's quadrupled already in like a few months. Somehow, I didn't want to buy it there, though. If I had bought it there, I would be like giga rich right now. And then somehow, oh, it's had a stock split, hasn't it? Okay, yeah, that makes sense. So this was obviously, I think, like 4 times, because it ended up hitting like $400 something, right? Or maybe 500? I can't remember. But anyway, somehow I thought that buying it, so actually, yeah, $4, when it was $4 here, it was actually probably back more like here when it was hitting $4. Yeah, because I remember in like late or like October or November of 2020, I was seeing it hit like $4 or $8 or something. Somehow I didn't think buying there was good, but I thought that buying at $240 was good. And then I didn't sell the day that you couldn't buy more shares. I was like, no, it's going to keep going up. But I didn't realize, like, no, they were manipulating the market. There were no shares left to buy, apparently. Also, maybe Citadel and Melvin Capital and their clearing firms maybe were doing some shady stuff to artificially suppress demand, right? To try to get out of their short positions. But so somehow I didn't buy at $4, but $240 I wanted to buy, or it was like, was it $240 or $220 or something? And then I didn't sell it when it was at like 400 something, I could have actually captured a profit when I saw that they were limiting the stuff. But anyway, the point is, it was going up a lot, and I didn't buy. And then when it was like when it was like almost 100 times or like 50 times higher than the price I was scared to buy at, then I bought it. That's the mentality of someone who doesn't know what they're doing. And the market relies on that kind of mentality for so much of its liquidity. You think that it's only like the big players that like are used as liquidity, but think about this. An uninformed retail trader is going to risk way more than their risk appetite truly can allow for, but they're not going to know that, right? They're going to essentially risk their entire bankroll on one play because they don't understand, right? Or a lot of their bankroll. And so these, like the articles and the Reddit and all that, has a huge influence over people who are desperate to make more money. They have like a decent amount of money, but they're desperate for more because they're thinking about how they're going to need more money down the road, and they need to quickly try to make more, right? There's so much liquidity from retail in that sense. So the uninformed dumb money, because there's always new uninformed dumb money coming in, right? Because the last round of uninformed dumb money, they already lost all their money and they left, right? Some of them may stick around long enough to become profitable, but that's going to be, 10 years later, maybe they'll be rich, or 10, 15, 20 years later. But most of those people are going to come in, lose all their money, and then leave. And then there's going to be a new round of people a couple years later, a couple months later, whatever, a new generation of people who are maybe younger or whatever, but they're coming into money now, and they're going to come in and fall for the same trick over and over and over again. So Wall Street abuses the new influx of retail money coming in every day that doesn't know what it's doing. Is these people, it's always these new first timers, second timers who are coming in, and they're about to lose it all, and they don't know what they're doing. So what do? They have to, like, almost rationally, they look to different news sources, and they just look around the internet or whatever, trying to figure out what the right play is, right? So the institutions, the asset managers that own all the media companies, know that if they can subtly or not so subtly influence what's being promoted on the sites that uninformed new retail money is going to come, they're going to come in looking for like a hint of what's going to happen next, so they can make money, right? So these asset managers know if they can control what's being pushed out, what kind of information these new retail traders are going to be finding when they try to do research, they can cause them to lose, and then they can take their money, right? It's very, very logical, actually. It's not a conspiracy theory. It's like it makes a lot of sense. So yeah, anyway, just think about that, right? So pay attention to what the sentiment is, what the news is saying, and how people are reacting to it, and what their thoughts are. Like sites like Reddit are really good for that, right? Because you're going to see some people who are duped, but you're also, what I believe, going to see a lot of bots and stuff, accounts that Advanced Publications is pretending are real people and real opinions, but really they're just trying to control the public, the masses, right? So they can take money from them. Okay, anyway, video's gone long enough, guys. I'll see you next time, but we'll stay tuned, and we'll start to see what plays out with this rate thing, and if it's going to cause another crash, which I believe it would. All right, take care, guys.